every real estate investor's journey. They think about real estate investing, they think about multifamily, and it has for so many years been sort of the darling asset class of real estate. But there are really so many different asset classes across real estate, and diversification is key. And also, in my position in dealing with investors on a very regular basis, I need to understand what is their risk profile, what is their return profile, what are they looking for in a deal? Are they looking for long-term appreciation and growth, or are they looking for short-term, more stable cash flow?
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome, Decoding Cashflow listeners. Today, we have an amazing guest, Danny Bellish. Danny is a founder of the Bellish Team, a real estate investment firm. And as a former NYC advertising executive, he has spent 15 years managing multi-million-dollar marketing budgets for Fortune 500 brands, but later decided to pivot to real estate in 2018 in pursuit for more passive income. He's a real estate syndicator and has grown from 4 units to more than 700 units. He has started 2 funds and 2 development projects in just under 3 years. And on top of that, he's also a full-time employee. He has a full-time job, and he manages to do all these things, So it will be very interesting to learn how he does and manages his time, and how he has scaled to this level. Danish, welcome to the show. It's a pleasure having you here.
Thanks, Ted. I really appreciate it. And I don't sleep much. That's the key to success, and also, a tremendous partner in my wife, Christine, who, without her, we wouldn't be anywhere close to where we are today. So appreciate you having me, and excited to dive in.
All right. So, Danny, before we dive into a specific niche or specific area, right? Can you give our listeners a little bit background about yourself? Before you got started into real estate, what did you do, and how you got started into real estate?
Sure. So I am a Queens, New York kid. I grew up in the city. My first career out of college was in advertising. So I was in the New York City corporate world, learning so much about what, corporate level work looks like, all B2B for the most part. But I really learned a lot about advertising, branding, communications, marketing, investor relations. And it was and has been and still is a tremendous career. I'm not necessarily the person who needs to escape the rat race or, wants to leave a terrible career in pursuit of entrepreneurship. I just sort of always wanted more for myself and for my family. And, in 2018, my wife and we knew that we wanted to generate more passive income in order to live the life that we want, have more time freedom and more opportunities to, spend with our family, spend with friends, do more charitable work, things that just really, we were passionate about. So I read a book by David Lindahl called Multifamily Millions, and I got hooked pretty immediately to the idea of passive income and generating wealth through real estate. So we ended up buying a small 100-year-old duplex down in Asbury Park, New Jersey, which, Ted, I'm sure you know a lot about Asbury Park. Very cool, hip, up-and-coming beach town. But what we didn't know is all of the things that we didn't know, right? Which happens in real estate a lot. So we ended up working with a total nightmare contractor on the deal. And a 3-month timeline turned into 9 months. We went $50K over budget. We ended up burying that deal. And essentially on paper, the deal looked really great. But we looked at each other and we were like, how the heck are we going to replicate this over and over to get us to a place where we can replace our income with this?
Yeah.
So that's when we found out about real estate syndication from a meetup that we went to in Manhattan. And essentially from there, we met our now partners who were much, much more experienced than we were. We ended up passively investing with them and then offering them about a year's worth of pro bono consulting in advertising, marketing, communications, and investor relations, because that's where we had expertise.
Yeah.
So we ended up offering that to them, doing all of this free work, building a friendship and a relationship. And fast forward 3 years now, we've done several multifamily apartment deals. We've done development deals. We started 2 funds for double and triple net lease assets, which we can dive into. But it has been a whirlwind of 3 years, and now we're here.
Awesome, man. That's a great story. What I'd like to learn is, as we talked about, right? You were a marketing executive. So how do you think that marketing executive perspective helped in real estate? Like, what do you see are the parallels between two fields?
Yeah, I mean, there's so many. Like, I used to think that there were none, that my skill set wasn't transferable to the real estate game because there was so much jargon and so many things that I didn't know, and contracts and lawyers and brokers, and there's just so much that I thought that I didn't know. But the reality is, if you come from a corporate background, chances are that you have the majority of the skill set that you need to be successful as a real estate investor.
Yeah.
And sales and marketing comes pretty naturally to me. And I think my corporate career only enhanced what a higher standard is for communication, for, being there for your clients and for your investors, and making sure you're being transparent and honest and creative and engaging. And I think all of that is necessary in real estate investing and syndication. So in syndication, we're raising money from passive investors that are looking to participate in large commercial deals and be hands-off. So the marketing aspect of knowing how to communicate with folks, and also getting in their mindset, getting in the mindset of someone who wants to be a passive investor in real estate, and meeting them where they are, understanding what their passions are, what their challenges are, what their wants are, is all important. And that all goes into marketing. So the more that you can really understand about your customer and cater your communication to that understanding, I think is vitally important to any business, let alone just real estate investing.
No, you're absolutely right? Marketing is one thing that you have to do in each and every part of this real estate business, right? While you're syndicating, like, for example, you're on my show, that's marketing. I do podcasts, that's marketing. I connect or provide newsletters, bi-weekly newsletters, or, information, educational material, that's marketing. So it comes very handy. The skill of marketing comes very handy, and it ties up and gives you much more leverage than the other people who hasn't been involved in the marketing at all before starting real estate.
Absolutely. And that last point I think is important too. So for, any of your listeners who do have a marketing background of any kind, or a sales background, I think what you find in real estate investing and in, syndication is sometimes, you look at these folks who have, amassed a lot of assets, right? Hundreds of millions of dollars in assets under management. So, your automatic thinking is, oh, these guys are a well-oiled machine. They've got it together. They know everything. There's nothing that I can help with. It's really not the case for a lot of these folks. They're entrepreneurs just like us, and they need help in a lot of areas that they don't have expertise in necessarily. So it was super interesting for me as I became friends with these guys to understand this is an area where I can really add value. and bring something to their table, because they, even with all their success, a lot of their operation is still mom and pop. So there's still a lot of ways that people can add value to folks who are much, much more successful, or in a place that they want to be eventually.
And these deals, right? Especially, I would say the multifamily deals, are they within New York, New Jersey area, or they're all over the US?
So our multifamily properties are primarily in Cleveland, Ohio.
Okay.
So we have a portfolio of about 600 units in Cleveland. And then we have an office to multifamily conversion project there. And we have a 42 unit new development project there. We have some small multifamily here in New Jersey, the Asbury Park deal, and we're house hacking right now, actually, in Garwood. And then we have our double and triple net leases pretty much all over the country in about 6 different states.
Awesome. Okay, let's talk about the different assets that you invest in, right? One is multifamily. The other is, you said you have a fund where you cater to double and triple net lease. Let's talk about those funds. Like, what are the different properties that segment of properties, right? Of course, it will become commercial, but what commercial properties do you invest under that fund?
Sure. So I think it also helps to talk about why we got into asset classes outside of multifamily. I think multifamily is like the first step in every real estate investor's journey. They think about real estate investing, they think about multifamily, and it has for so many years been sort of the darling asset class of real estate. But there are really so many different asset classes across real estate, and diversification is key. And also, in my position in dealing with investors on a very regular basis, I need to understand, what is their risk profile? What is their return profile? What are they looking for in a deal? Are they looking for long-term appreciation and growth, or are they looking for short-term, more stable cash flow? Yep. So, we were doing B and C class multifamily deals for a long time, and development deals, and a lot of these are appreciation heavy. You put a lot of work into them, and the cash flow can sometimes be very variable. So we wanted to, especially, with a recession happening, or upcoming, and all the volatility that we've seen over the last couple of years, we wanted to pursue an asset class that we found to be much, much more stable and steady when it came to cash flow. So we started a fund to buy double and triple net lease assets. Okay. So basically, these are retail locations that you drive by and purchase from every day. It's, the Dollar General that you bought party favors from. It's the Starbucks that you got coffee from this morning. It's the AutoZone that you took your car to. All of these are businesses that are tenants of the landlord. So what we do is we buy the building and the land where an essential business like a dollar store or an urgent care center is already operating and is your tenant. And part of the beauty of these double and triple net leases is, they come with long-term leases. So these leases could be 5 to 25-year leases. They have built-in rent increases in the lease. Oftentimes they corporate guarantee it. So, Dollar General will corporate guarantee the lease, meaning if I have 10 years left on the lease and they decide they want to close the doors in 4 years, they still owe me 10 years of rent payments, and they make due on those rent payments. Okay. And I think the best part about it all in terms of, stability is what double and triple net really means is that the tenant actually covers the vast majority of the expenses associated with the property. So not only are they paying you rent, but they're covering the property taxes, the insurance, a lot of the utilities, the maintenance. So it's super turnkey when it comes to a cash flow product.
Yeah, and you hardly get a call from the tenant. It's all, you get a paycheck, you get a rent every month. but no calls.
It is the ultimate like mailbox money, sleep money. It's a tremendous asset class that we've been able to dive into. So we bought 5 in our first fund last year. There were $3 stores, $1 general, 2 family dollar stores, and actually 2 veterinary care centers, but corporate veterinary care centers. One is backed by Mars Inc. The other one is VetCore, and they operate over 500 locations across the country. So to your point, I don't ever hear a peep from these guys, and the rent shows up on the first of the month, every single month without fail.
Yeah. So the best thing about this commercial real estate, right, especially the triple net lease, it's a very steady income. You don't see too much highs, too much lows. It's a steady income. It's not like, in some cases like multifamilies, you get there's too many ups and downs. Either, you can crash, your prices can crash, or if you do a really good value add, it exponentially, jacks up. But this is a very steady asset for a particular kind of investment who wants a steady cash flow without a beep.
Yeah. And this is partially why my wife and I chose it too. If we're looking for an exit from corporate for both of us, multifamily is great, but like we need something that we can rely on. We need a foundation, right? I don't tell people, unless they're in certain situations where they only want cash flow, that's all they care about, and they don't need a 20% IRR, a 25% IRR. They want steady cash flow and they want tax benefits and capital preservation. This is the thing for them. For us, we're in our mid to late 30s and we wanted diversification. So we get a much different return profile between our B class multifamily, C class multifamily, A class multifamily, development, and now net lease. And this really is the thing that has actually given us a check every single month without fail. So we want to continue buying these. And right now, there's so much focus on other asset classes. And because of the economy that we're in right now, there's a ton of runway and a ton of white space to be able to take these down at a good cap rate.
Yep. And talking about your development projects, right? Can you throw some more light on it? What kind of development projects are these, and in which area?
Yeah, so we are evaluating some new development projects right now, including a 30 unit in Scotch Plains, which you would know it's a beautiful and affluent area. But the development projects that we've been a part of already are in Cleveland. It's a 42 unit called the Lumos, and another one right next to it called Park Lamont, which is actually a stone's throw away from Cleveland Clinic Hospital. So Cleveland Clinic Hospital is the #2 hospital in the entire country, and they're going to be adding 10,000 jobs over the next 10 years. So they are doing massive expansions of Cleveland Clinic. And it's a great opportunity for us to have that proximity and get those hospital professionals, whether they're doctors, nurses, hospital staff. So we give special recognition to them and special pricing to them to, rent from our facilities and pre-lease there. So we've had a lot of success building that in that area. One of my partners is boots on the ground there. So he's able to, work with the city and get all of the permitting that we need. And we travel back and forth there probably once a quarter. And then we have another project that is having a little bit of a tougher time, and that's an office to multifamily conversion, which a lot of people did see as a huge opportunity since the pandemic because of the work from home. So people were like, okay, what do I do with this office? And investors thought, you know what, this is my opportunity to buy, offices at 50 cents on the dollar and convert them to multifamily. However, with all of the rate hikes that are happening, there's a lot of, constricted lending. So those construction loans are a lot harder to come by and much more expensive and much lower LTC than they were before. So we are having to be very creative in our solutions and now what to do with that project. Do we still turn it into multifamily? Do we turn it into a data center? Do we tear the building down and try to sell the land to a developer? So there's a lot that goes into some of those projects, and especially the heavier the lift, the more risk that there is, the more opportunity that there is. So you have to weigh as an investor, what else do I have in my bag? And how much time, energy, resources, money can I put into this, high risk, high reward project?
Yeah. It's evaluating the best use and best value that can be generated through that project, of course. So that project, I think it's still at the initial level. You just bought and you're just evaluating what needs to be done. You go ahead with the office conversion, office to multifamily conversion, or maybe office to, as you said, data storage, or self storage. I'm not sure if that's possible, but normally, if the building is without, no windows, less windows, it's easier to convert them to the self-storage building. But office building normally has everything, depends on where it is, but mostly glass around it.
Exactly. And frankly, I'm learning a ton through this process also of, like we have transformers in the basement, and we also have a big parking garage underground. So that affects certain things that we can do with the property as well. So again, being a real estate investor is all about being creative. Financing, of course, is a huge part of how we execute our deals. So making sure that we have the right lending partners, shopping around when you need to, and finding other opportunities that you can use and the best use case for a particular property. Even if you have to deviate or you've put money into, a particular route, if you need to be flexible, if you need to pivot, you have to do what you have to do, and you have to make decisions quickly.
Yeah. And in this development project, what is the deal structure normally in the development, like the cash flow, right? Because the development takes a while, depending on how big it is, right? Maybe from 18 months to 36 months, depending on the size of the property. So does the cash flow start from the beginning, after a year, or once the development is completed? How does it work? And the other thing is, do we plan to sell this property, or it is built to rent?
So this would be a build to rent situation. So when we're working with our investors, there's so many different structures that different syndicators use, different waterfalls or different performance indicators, or they do a preferred return or they don't. We like to keep it really simple for the most part. So we do a straight split. So our development deals are usually a 70-30 split favoring the limited partners. Our multifamily deals and our net lease deals are 80-20 favoring the limited partners. And usually what happens with development is we raise for the project, we develop the project 18 to 24 months, we lease up, and then we do a refinance, in which at that point, we're usually able to pay back a healthy amount of the initial investment back to investors. And that's the point at which we cash flow. And then we hold, the ideal sort of hold period for us that we've seen is about that 5 to 7 year mark, depending on the asset class. If it's humming and it's cash flowing, like it's nobody's business and everybody wants to stay in the deal, we'll consider holding on to it. But from a tax purposes, we like the depreciation, and you get a lot of that, more sooner than later. Also, with these development projects, the longer that you hold on to them, of course, they don't become so fresh and new anymore, right?
Yeah.
Then you have more maintenance costs, you have more CapEx. So we usually like to exit those, anywhere between usually around the 5-year mark.
All right, sounds great. Because see, we are also into the same space almost. Okay, what we do is we are into luxury single family house construction in northern part of Jersey, as well as we do small multifamily construction, anything around 20-25 units in Hudson and Bergen County. Yeah. And as you said, right, normally that's why everyone has a different structure. In our development project, what we do is we don't start the cash flow until the project is completed. Because otherwise what happens is we'll have to get more investors on board to make that payment.
Right.
And that will dilute the revenue, the return for the other investors.
Totally. Yeah. And you're not generating any revenue, to your point, right? Like, you want your business to be paying out your investors, not for investors to pay investors, right?
Exactly.
So I totally hear you. And so I think that's the smart and strategic and healthy way to go about it.
Yeah. And the thing is, right, investor waits, they wait for like 18, 24 months, but they get much higher return at the end of the day.
Right. Right. Everybody gets attracted to the potential of, either doubling or tripling your money in a certain period of time, right? But I think the thing to keep in mind and is, you always want to bet on the jockey and not just the horse, right? So, Ted, I'm sure you have a tremendous track record, and that's why investors go to you time and time again, right? That's what's important. What I see a lot in the space, and I talk to dozens upon dozens of investors each week, and it's you can very easily get lured into projections, right? With this deal, I can triple my money. Why would I do this other thing that has a lower return? Well, you have to know, how that operator underwrites. How does that developer underwrite? Are they being conservative? Have they closed deals before or exited deals? I think there's so much more that goes into it. And especially in the multifamily space right now, to be honest, I see so many inflated projections that have, they offer 4% cash flow, but a 25% IRR. And I'm like, that doesn't make sense. If you really look at it, they're betting on appreciation. And, you just don't know what's going to happen years down the road. So, I like to bet on cash flow. I like to bet on the operator and the business. And then the rest will take care of itself.
Yeah, because what I've seen is, you rightly said, right? Right now, because of the interest rate hike, it's tough to underwrite so many deals. It's very tough to underwrite the deals because the seller expectation hasn't been realistic yet. There is a too wide spread between the cap rate and the interest rate. So after penciling few deals, they try to stretch themselves. Some of the operators, they try to stretch themselves, trying to make the numbers, and they'll try to offer a very low return cash flow on monthly and quarterly basis, and they will project a very high IRR at the back end. As you mentioned, they feel like, okay, the rates are going to go down, will refinance, the property is going to appreciate. So all those different projections, but you have to be realistic, right?
You want your assumptions to be realistic. It's really tough, to make assumptions about what's going to happen with interest rates, because everyone who's underwater right now clearly didn't think that the Fed was going to hike rates at the fastest pace in 40 years, right? So, how do you account for those things? How can you operate your property effectively, even in the worst of conditions, I think is what you look for versus, projecting out in the best of conditions.
Yeah. And many of them, they had the floating rate. They didn't hit the interest rate cap expiring, within maybe this year.
Like right now.
Yeah.
So we're in a deal, 293 units that had floating rate debt, and we bought a rate cap, and our rate cap comes due in February, and we just got quoted for a new rate cap at $350,000. So these rate caps are extremely expensive. And we actually did an analysis of our last rate cap, and it was well worth it. We spent about $250,000 on it, and as of now, it's been about $325,000 in savings. So it was worth it, and it will continue to be worth it. Hopefully, we start to see the 10-year treasury dip a little bit. We start to see rates dip a little bit, and that will be a blessing for us all.
Yeah, and as you say about the 10-year treasury, right? We already see the dip. It touched 4% recently, and now Treasury is coming down. Hope the interest rate also, the bank interest rate comes down too along with it.
Yeah, absolutely. You know, I, as an investor, you know, I talk to a lot of, colleagues, and everybody is, mad at the Fed. Why have they hiked so high? Why have they taken so long? I'm kind of a contrarian in that way. I think they actually did a pretty good job in taming inflation. Inflation got so out of hand across our properties. Insurance has gone up 25%.
Yeah.
Labor, materials have gone up 20 to 40%. So that has hurt our business in a completely different way, right? So I think that those hikes were timely. I would like them to stop hiking and start cutting now so that we can look to a profitable 2024. But I think that's what we're looking for. I think we're, as commercial real estate investors, and even on the residential side, I think 2024, 2025 will be a tremendous period for more growth and buying.
Yeah. And this interest rate hike, right? Once the hike takes place, the effect of that hike comes in place after like 6 to 9 months. So we'll see what happens, early next year. Would it be a recession, or would it be a stagnant economy for a while until the interest rate goes down? We'll see, right?
Yeah, we'll see. And to your point, like, nobody has a crystal ball, right?
Yeah.
So that's why, we like to diversify. That's why, regardless of what happens with inflation or the economy, our double and triple net leases are still going to send us checks every month. So, and there's no tenants who are going to up and leave our property and leave it in disarray, or if the roof or boiler blows or something. These are all things that they are responsible for. So just another reason why that you want something steady in your portfolio to help hold you down, especially during these more volatile economic times.
That's a good diversification. You, of course, all your investment needs to be diversified. Don't keep everything in stocks and bonds. Put something real estate, some other assets, and within real estate also, as you mentioned, you need to diversify, not only on one asset class.
Yeah, and that was a super interesting learning for me too. Like I said, I, like so many other people, you learn about real estate investing, first thing you think of or learn about is multifamily. And then once you start to really learn what the values and opportunities are of other asset classes, industrial is huge now, and warehouses, cold storage, you mentioned, storage before, storage units, tremendous businesses that you can build. They might not be as sexy as a development project in Miami, but these are the things that can create generational wealth for you without getting too many gray hairs young.
That's true. Yeah. All right. So Danny, with all this work in your hand, how do you balance your work, your 9 to 5, versus these all investment projects?
Yeah, that's a great question. I have no idea. It's been a wild few years. I, first and foremost, my wife is the reason that we are able to do this. First and foremost, she is not only my rock, but she is the leader of our business. She is in it day in and day out, day and night and weekend, and she is an absolute beast. And if it wasn't for her being my partner in all of this, it would be a totally different story. So first, I have her also. But every waking hour that I have that I am not working in my corporate job, and even sneaking in a few hours during my corporate job sometimes, hopefully they're not watching this, but it is it is working toward my goals of
Yeah.
being an entrepreneur and, wanting to create a better life for myself and my family. So,
Yeah.
um, it's making the time. That's all it is.
Yeah.
You got to do what you got to do. We have investors; they are counting on us, and we have a responsibility and a fiduciary responsibility to them to do everything in our power to make these investments a success. So
Yeah.
that's what we do, and our people know that we are relentless in that pursuit.
And it's always about, a mindset, right? When you're working extra hours on the side gig, it's not like you need to have a mindset of you're not working extra hours to pay extra bill. You're working extra hours to build a fortune. So that kind of mindset, when you have, it always, gives you a kick to work more, put some extra, over the nights, weekends, do everything possible to get and build the generational wealth that we are talking about.
Yeah, absolutely. It is a sacrifice,
Yep.
and it is about understanding how much you are willing to delay your gratification for the things that you want, right? How
Yep.
much do you want it? How bad do you want it? And that's what should drive you every single day and answer the question of, should I work even though I'm tired? I know it's Saturday, but like, should I work on this thing, or should I, lay in bed and watch another movie or whatever it is? And sacrifice doesn't always just come with time or missing someone's birthday or something. Sacrifice comes with, sacrificing relationships, sacrificing, me putting all into my corporate job and wanting to climb the ladder the way I always thought that I did before. Your life takes turns and pivots. Success is not linear. You need
Yep.
to take different roads and try to figure out what's best for you and what you kick ass at, and then dive headfirst into that.
Mm. Yep, absolutely right. So Danny, I think we can keep going for hours and hours, right? So maybe we'll switch the gears a
Well,
little bit.
offline for that.
Yeah, we'll switch the gear and move to the final round of questions. All right. So before we get started, one last thing I want to ask you: is there anything specific that you would like to tell our listeners about any insight or advice for our inspiring investors?
So one thing that I really like to live by is, um, I play the long game when it comes to people and opportunities. Relationships are the most important thing that you can have, not just in real estate, but in your corporate job,
Mhm.
and just in your life. And fostering those relationships and showing up for people when they need you is vitally important to not only your success, but your happiness. I think the other thing that's important there is, don't be afraid to be friends with people who are ridiculously successful. They are people too. They want and need friends also. There are ways to earn their trust and be friends with them. And it's about being thoughtful. It's about saying happy birthday when it's someone's birthday or their anniversary, or, they got a promotion, sending them a bottle of champagne or something that's thoughtful. Investing in other people will get them to invest back in you, and you will watch your life flourish in front of your eyes.
Rightly said. That's right. All right. What is the one book that you will recommend to our listeners, which had a major impact in your life or in your business?
So I read a lot of books. I read probably like 100 articles a day, but there's a book that I just read that I just have right here. It's called
Mhm.
Ready, Fire, Aim by Michael Masterson.
Okay.
I love this book. It's Alex Hormozy actually recommended it, and I started reading it. And
Mhm.
I come from a sales background, so I understand the value of sales and what sales really means, and the difference between sales and, let's say, marketing. Two completely different things. You
Mhm.
can always have a business if you are a good salesperson. You won't always have a business if you just have a good product, right? So this book, I think, really accentuates the need to be a good salesperson and how you can build a business around getting customers and attracting customers to your product, and how to grow that from $1 million business to a $10 million business to $100 million business. So it talks a lot about those fundamentals that really can help you grow and scale in a major way.
All right. I'll add to my list of books to read.
Do it. It's a good one. And it's entertaining too. You know, some books are dry and they're hard to get through. This one it's super interesting, and it comes from someone who has consulted on many businesses. So it's really cool.
Awesome. All right. What are your main source of information to learn and grow?
So I read articles, like I said, every single day. So I just get these push notifications of topics that I'm interested in across everything from the Wall Street Journal, Harvard Business Review, Seeking Alpha. You know, there's a plethora of them that I just get. I skim them or I'll read them. They're usually short form articles, but it keeps me informed and up to speed literally every single day and from a number of different perspectives. So I think that's super important to make sure that you get different perspectives and that you keep up with the information every day, because it's just going to make you, you're going to be able to weaponize that information socially much more regularly than you might have before.
All right. And what is the one way you like to give back to the world?
So a couple of ways. And the first way is we got into real estate syndication because we wanted to provide more opportunities for our friends and family. And they are all invested with us in these deals. And that is one way where we thought that we could use some of our now expertise and some of these things that we're getting involved in to lift all of our family and friends up together. And that's what it really is all about for us. We're not in competition with our friends and family. We want to see everyone be successful, and we genuinely care about people and genuinely care about the relationships that we've built. So we like to, you know, not only bring people into these deals, but celebrate our wins. We like to have fun. We like to, you know, go out. We like to celebrate and bask in these things that we're doing together. And it brings us so much closer to the people who are involved in them. So that's the way that we want to give back, is by being the best friend that we can possibly be.
Yep. All right. Last question. How can Decoding Cashflow listeners get in touch with you?
Sure. So we are very active on social, mostly Instagram, Facebook, TikTok, at the Bellish Team. And anyone who wants to shoot me an email, I love talking about this stuff and you know, talking about how we're helping people. A lot of our investors are actually, you know, aspiring syndicators, aspiring real estate investors. They're not just all, you know, corporate people who want to be passive. So I really like to take the time to educate folks and teach them how I got here. I had a lot of help, you know, to get to this place. So I like to help too. So if anybody, you know, wants to have a chat or shoot me a note, Danny@thebellishsteam.com is my email. Feel free to reach out. I'd love to make more friends.
All right. Sounds good, man. Thanks a lot, Danny. It was a pleasure talking to you, and we'll surely stay in touch.
Thank you. I appreciate it, Ted. Thank you guys all for listening.
All right. Thank you.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow. And we'll catch you in the next episode.